All right, Ben, so all of this said, people are, and I think most people intuitively know stocks beat bonds, but for the first time, they're thinking, well, 5% risk-free in bonds ain't bad. So what are you hearing and what are you recommending?
Hi. So, yeah, thanks for having me on the show. So, for sure, cash at 5% is better competition with stocks than it was when cash was at 0%. That said, over the long term, stocks do outperform less risky assets. So, I co-manage a portfolio called the Investment Income Builder. It's a portfolio that's returned 9.5% over the last 20 years, of which 5% is income, and another 4.5 or 5% comes from growth over time. So if you want to look at over a very long time period, stocks tend to go up 8 years out of 10, and cash or money market or something very much like that is actually the riskiest thing you can do from a long-term total return perspective.
Sure.
From trying to achieve your financial goals.
So it's basically just saying to people, and we've seen this, and sort of what Bob's talking about makes me think about it too, this idea that, you know, if you miss the biggest days, you've missed the whole thing. Like, it's time in the bigger risk is kind of missing it and being on the sidelines. What about people who are like, I more or less am fully invested or I'm comfortable where I'm invested, but I'm not sure about sort of adding to that position, or why not have, a position in treasuries? And I think a lot of people, too, are thinking that the market might weaken. You yourself sound like you think the recession is only delayed, not canceled. So some of this cash is just being opportunistic.
I think that's right. I think you want to have a barbell portfolio. So you want to have some cash and some less risky assets for when the market does give you an opportunity to buy more. But you also always want to have some exposure to those assets that can grow over time. So being active stock pickers, active portfolio managers, active bond managers, we actually think that we can outperform the market over time. So as Bob was alluding to, many stocks have zero return over time. And most of the return comes from a relatively select few. So as active managers, our goal, our job is to put the portfolios in position to have exposure to those better investments. What
does it mean for the market, Bob? I'm just pulling up some of the stats I've been collecting. For instance, money market assets hit a record of $5.6 trillion. This is from ICI last week. So is that, Bob, considered a bullish sign for the market because that's all on the sidelines, maybe waiting for an opportunity? Or are we seeing headwinds for the stock market that we haven't had in 15 or maybe 30 years?
Both of the things you just said are correct. Yes, it's cash on the sidelines and could come into the market, so it's potentially bullish. But yes, and I think it's wonderful that bonds are finally, look, below 1%, giving the government your money for 10 years below 1% is crazy. That's what was an anomaly. What we're in now is more normal. If you look at the historic return, like at a 10-year yield, it's much more common to be in the 4 to 6% range than it ever was to be in the 1% range. Same with mortgage rates. Nobody's happy with mortgages at 7%, but it was 3% mortgages that were the anomaly. They never were 3% before. That's extremely unusual. Where we're in now is more normal. So I think it's wonderful that bonds are providing some competition. It's not great for stocks. The equity risk premium for owning stocks is terrible right now. That's one of the reasons the market might be having a little problem right now. But I'm much more comfortable with savers like my mother getting 4% on her or 5% on her 1 year yield, a 1 year bank CD than getting nothing in her bank savings account. So I think this is all a positive development, even though it's serious competition for stocks.
Ben, I'll give you the last word, and maybe it's tactical. There are some names in here. I see TSMC, some individual names. Maybe it's not NVIDIA, but entice the people who are like, come on, entice them in.
So look, there's still a lot of value in the market. There's individual stocks that have certainly run a lot. Their valuations are high. Bob alludes to a low equity risk premium. That's true for the market as a whole. But look, take out some of those stocks that have outperformed very strongly. There's still a lot of value in the market. So a company like Taiwan Semiconductor, there's some geopolitical risk there, but this is an important company in the world. They have free cash flow. They have growth. The valuation is attractive. We think it's just going to be a much bigger company over the next 5 and 10 years. It's going to grow a lot faster than that 5% cash will.
All right. And there's a couple of the other, Charles Schwab for the brave ones, CME Group, Orange, a broad mix there. Thank you both very much for your time today, Ben Kirby and our very own Bob Pisani.